You think control comes from owning 51%. That assumption belongs to an older system. In China, control begins at 1%. It is called the golden share, and it exists for one purpose: to separate ownership from authority. This is not a loophole or a technicality. It is a deliberate governance weapon designed to override capital with political command. On February 6, 2025, 17 U.S. states launched a coordinated investigation, not into Chinese companies, but into American retirement money. Public pension funds, state-managed assets, and long-term savings vehicles were placed under scrutiny. What investigators uncovered was not hypothetical exposure, but existing structural compromise. The figure attached to that compromise is $73 billion. That money belongs to teachers, firefighters, police officers, and public employees. It was allocated through respected financial institutions, following approved guidelines and index mandates. On paper, it was invested in private Chinese technology and growth companies. In reality, those companies are not private. The golden share is a 1% equity stake taken by the Chinese Communist Party or its proxies. It does not behave like normal equity. It comes with special board representation, veto authority, and binding influence over strategic decisions. That single share overrides the economic interests of every other shareholder. This changes the meaning of investment entirely. Your 401k believes it owns part of a company seeking profit. Through the golden share, that company is legally obligated to serve state objectives. Technology roadmaps, data access, partnerships, and resource allocation can be redirected without shareholder consent. The distinction between civilian enterprise and state instrument disappears. This is the shock most investors never see. Wall Street presentations describe diversification, growth exposure, and emerging market opportunity. None of those slides explain governance control. None explain that capital enters freely, but authority never leaves domestic hands. Ownership is invited. Control is not shared. This arrangement is not accidental. The golden share exists because the system anticipates foreign capital inflows. It ensures alignment is enforced at the moment of entry, not negotiated later. Once embedded, the structure cannot be challenged by outside investors, regulators, or courts. Exit does not reverse control. Selling shares only transfers ownership to the next participant. This is stage 4 behavior. In stage 4 systems, paper ownership remains intact while real control migrates silently. Contracts are honored, markets function, returns appear normal. But the underlying authority has already shifted. By the time this becomes visible, the mechanism has been operating for years. The investigation did not reveal corruption. It revealed design. And once design is exposed, the illusion of neutral markets collapses permanently. The pattern. The merchant's betrayal. This pattern is not unique to China. It is one of the oldest failures in economic history. It appears every time a dominant society convinces itself that money is neutral and profit is detached from power. Financial elites tell themselves they are above geopolitics until geopolitics consumes their balance sheets. The cycle always begins with access. A rising rival opens its market selectively. Returns are high. Growth looks inevitable. Financial institutions convince themselves that participation is temporary and optional. They repeat the same phrase every time. Money has no flag. History shows that phrase is always wrong. Merchants sit between states and systems. They see opportunity before danger. They extract fees, commissions, and performance bonuses while risk remains abstract. When warnings appear, they are dismissed as political noise interfering with efficient markets. This is the merchant's betrayal. Short-term profit overrides long-term security. Financial elites fund the rise of a strategic rival while believing they can exit before consequences arrive. They assume markets will warn them early. They assume liquidity equals safety. They assume control can be reclaimed later. It never is. In this pattern, capital flows first. Governance capture follows. Dependency forms quietly. By the time risk becomes visible, exit no longer matters. Assets may still be tradable, but authority has already shifted. Wall Street repeated this logic with China. At the state level, China was labeled a strategic adversary. At the financial level, it was framed as an indispensable growth engine. Banks, asset managers, and index providers chose access over alignment. They justified exposure as diversification while ignoring governance realities. The golden share exists because China understands this pattern perfectly. Foreign capital is welcomed. Control is never surrendered. Governance is embedded at entry, not negotiated later. This ensures that even if sentiment shifts, authority remains intact. Capital becomes captive without realizing it. American institutions believed they could profit without consequence. They believed political structure could be separated from economic return. They believed that exit would protect them if conditions changed. The golden share makes those beliefs irrelevant. Once capital enters under this structure, it serves state objectives regardless of investor intent. The merchant is paid early. The system pays later. When the reckoning arrives, assets are frozen, written down, or repurposed. History does not punish betrayal immediately. It rewards it first. That is why the pattern repeats. By the time consequences become unavoidable, the merchants who enabled the shift have already moved on. What remains is a society discovering that it funded the erosion of its own leverage. This is not miscalculation. It is a cycle. Historical proof. When Wall Street funded the enemy. This pattern has already played out in full, not symbolically, not academically, but materially. In the 1930s, American financial and industrial elites made the same calculation they are making today. They believed they could profit from a rising adversary while remaining insulated from its ambitions. They were wrong. Before World War II, Nazi Germany was not treated as an inevitable enemy by global capital. It was treated as an opportunity. The German economy was reindustrializing rapidly. Labor was cheap. State coordination ensured scale. For corporations seeking growth during the Great Depression, Germany offered margins that did not exist elsewhere. American capital flowed in. Companies like Ford, General Motors, and IBM did not invest accidentally. They entered Germany deliberately, negotiated directly with the regime, and expanded production throughout the 1930s. Their factories produced trucks, engines, machinery, and data systems. On paper, these were civilian enterprises. In reality, they formed the industrial backbone of a war machine. This is the first critical lesson. Financial systems do not distinguish between civilian and military use when profits are aligned. Capital is indifferent to outcome. It funds capacity. What that capacity becomes depends on who controls it. In Nazi Germany, control belonged to the state. American executives understood the political reality. They knew Germany was rearming. They knew the regime was authoritarian. They knew ideology was not compatible with liberal democracy. None of that mattered while access and profit remained available. The same justification was repeated. Engagement would moderate behavior, commerce would civilize politics, and exit would be possible if conditions changed. Those assumptions collapsed instantly when war began. Once hostilities started, American-owned assets in Germany were seized or rendered unusable, factories were repurposed, technology transferred, corporate claims evaporated. Legal ownership meant nothing once physical control shifted. Paper assets did not protect capital, they trapped it. This is paper versus physical resolving under stress. The corporations involved did not lose because they were naive. They lost because they believed ownership equaled control. In reality, control had already migrated to the state long before war made it visible. By the time recognition arrived, the mechanism had completed its work. This is exactly the same error being repeated today. Modern investors believe they own Chinese companies because they hold shares. They believe governance follows capital because that is how Western systems function. They assume that boards answer to shareholders and that law arbitrates disputes neutrally. None of those assumptions apply under the golden share system. China learned from history. The golden share exists to prevent the mistake Nazi Germany allowed: foreign capital without embedded control. Where Germany relied on ideological loyalty and later seizure, China embeds authority from the start. It does not wait for crisis to assert control. It makes control permanent at entry. This is the second critical lesson. State-aligned systems do not allow capital to remain neutral. They treat it as a tool. Foreign investment is welcomed not for partnership, but for capacity building. Technology transfer, expertise, and scale are extracted. Governance ensures alignment regardless of shareholder intent. American capital is performing the same role it did in the 1930s. Pension funds, index funds, and asset managers are providing long-term patient capital. The capital funds infrastructure, research, manufacturing, and data systems. Through the golden share, the state determines how those assets are used. Investors receive returns until they do not. Control never belonged to them. The difference today is visibility. In the 1930s, many executives claimed ignorance after the fact. Today, the structure is public. The golden share is documented. Board rights are explicit. Veto power is written into charters. There is no ambiguity about control. The persistence of investment, despite this clarity, signals stage 4 behavior. In stage 4, systems continue operating even when their contradictions are exposed. Profit incentives overpower strategic caution. Institutions assume someone else will act. Regulators defer. Index providers automate exposure. Capital flows because the machine has no brakes. This is why the historical comparison matters. The Nazi Germany case demonstrates that financial elites always underestimate state control in adversarial systems. They assume markets will protect them. They assume contracts will hold. They assume neutrality will be respected. History shows none of these assumptions survive conflict. Once political objectives assert dominance, financial claims become irrelevant. The golden share ensures that assertion happens quietly, legally, and early. There is no need for seizure or expropriation. Authority is already in place. The investor does not lose ownership immediately. They lose relevance. This is more efficient than confiscation. It allows capital to continue flowing. It avoids panic. It preserves market optics. And it ensures that when alignment is required, compliance is automatic. That is why the mechanism is superior to brute force. The United States is repeating the same cycle because the incentives are identical. Asset managers earn fees on assets under management. Index providers earn licensing revenue. Banks earn underwriting and advisory income. None of these actors bear the strategic cost of misalignment. That cost is deferred to the state, the public, and eventually retirees. This is the final lesson of the historical proof. When financial elites fund an adversary, they are not punished immediately. They are rewarded first. The punishment arrives later when options no longer exist. By then, the system has already shifted. In the 1930s, America had to fight the industrial base it helped build. Today, American capital is funding systems that do not need war to assert dominance. They rely on governance, dependency, and time. The golden share replaces the tank. The board seat replaces the factory seizure. History does not repeat loudly. It repeats structurally. And once the structure is in place, reversal is mathematically impossible without accepting losses that no institution is willing to acknowledge. That is why this is not a warning. It is recognition. The trap today. The MSCI algorithm. Most Americans did not choose to invest in China. That is the central misunderstanding. They did not open a brokerage account and decide to fund an adversary. The exposure entered their retirement accounts automatically through a system designed to remove human judgment. That system is called passive index investing. Over the last 2 decades, pensions and 401k plans shifted away from active management. Fees were framed as waste. Judgment was framed as bias. Index tracking was sold as neutral, scientific, and safe. What was never explained is that indexes are not neutral. They are curated power structures. When an index changes, money moves. Index providers like MSCI decide which companies qualify as investable. When they add a company to a global or emerging markets index, trillions of dollars are forced to follow. Pension funds tracking that index must buy, regardless of risk, politics, or governance structure. The algorithm does not ask permission. This is the trap. Chinese companies with golden shares were added to major indexes. Some had direct ties to military development, surveillance infrastructure, or dual-use technology. Once included, American retirement money flowed in automatically, not because of a vote, not because of intent, because the index said so. This is delegated decision-making at scale. Fund managers defend the system by claiming they are only following benchmarks. Trustees claim they are fulfilling fiduciary duty by minimizing tracking error. Regulators claim exposure is indirect. Responsibility is diffused until no one is accountable. Meanwhile, capital keeps moving. This is how $73 billion of public pension money became exposed. Not through conspiracy, but through automation. A system designed for efficiency eliminated discretion. What looked like safety became vulnerability. The golden share exploits this perfectly. China does not need to persuade individual investors. It only needs inclusion. Once a company enters the index, the capital arrives, regardless of governance risk. Control is embedded. Returns are delivered. The system appears to work until alignment matters. This is why the trap is so deep. Passive investing assumes markets price risk correctly. That assumption fails when risk is political, strategic, and structural. Markets do not price governance capture until it becomes visible. By then, the capital is already committed. This is stage 4 behavior again. In stage 4, systems are optimized for smooth operation, not resilience. Automation replaces judgment. Scale replaces caution. When the environment changes, the system cannot adapt without breaking itself. Turning off the algorithm means admitting failure. Index providers continue to add exposure because removing it would force massive rebalancing. Asset managers continue to track because deviation risks underperformance. Pension funds continue to comply because alternatives require decision-making and accountability. No one wants to be first to step away. This is why the trap persists even after exposure is public. The investigation by 17 states did not uncover hidden wrongdoing. It uncovered systemic inertia, a machine that continues operating even when its outcomes contradict national interest. That is the defining feature of late-stage financial systems. Capital is no longer guided by strategy. It is guided by process. Once process dominates, control disappears. The algorithm does not understand geopolitics, does not understand adversaries. It only understands inclusion criteria and weighting formulas. This is how a 1% golden share can capture billions, not through persuasion, through automation. And once retirement systems are wired into that automation, unwinding it becomes slow, contentious, and politically costly. The exposure does not end quickly. It lingers, compounds, and normalizes itself. That is the trap. Not malice, not ignorance, but a system that no longer knows how to stop itself. Resolution. Reset. Paper ownership, real control. This is not a scandal that resolves with better disclosure. It is a structural outcome of a system that confused ownership with control. Paper claims created the illusion of neutrality while real authority was designed elsewhere. Once that split occurs, reversal is no longer a policy choice. This is stage 4. In stage 4 systems, markets continue to function while meaning drains out of them. Contracts remain valid, shares trade normally, returns may even appear stable, but decision-making power has already migrated to the layer that cannot be voted out or diversified away. This is paper versus physical resolving inside finance itself. Your retirement account holds paper ownership. Governance determines physical control. The golden share ensures that control does not follow capital, no matter how large the investment becomes. That makes the outcome mathematically impossible to reverse without accepting losses the system is not prepared to admit. The historical cycle is complete. Financial elites funded an adversary, automated the exposure, and deferred accountability until exit no longer mattered. This is how empires weaken, not through collapse, but through misaligned incentives that quietly harden into permanence. The reset does not arrive as a crash. It arrives as recognition. Subscribe to Epoch Atlas to understand how these mechanisms are built, why they repeat, and how control shifts long before headlines acknowledge it.